Chapter 16, Part 2, focused on the performance of service firms. This section focuses on merchandising firms. Merchandising firms are inherently more complicated than service firms because they buy goods from their suppliers and then generate their revenue by reselling those goods to their customers. Therefore, they have two types of costs. Period costs, that is, the cost of operating the firm, and product costs, the cost of the merchandise that they sell. The period costs are all of the firm's selling and administrative costs, and they are expensed in the period when they are incurred, just as we did for service firms. But the product costs are the costs of the firm's merchandise. We call these costs inventoriable because they are attached to the firm's inventory. The cost principle, which you may remember from financial accounting, tells us how much cost to record for the inventory. It says that we record all costs necessary to acquire the asset and get it ready for its intended use. For inventory, that would include the acquisition cost of the merchandise, any sales tax, the cost to get the merchandise shipped from the supplier to our firm, and any other small costs of getting the merchandise ready for sale. Once we've acquired the merchandise and recorded its costs in our accounting records, what happens to those costs depends on what happens to the goods. The matching principle tells us that the cost of the goods that are sold during the period go to the firm's income statement as cost of goods sold. But the cost of any unsold goods stay on the balance sheet as merchandise inventory. We need some basic inventory formulas so that we can understand what happened to our inventory costs during the period. The firm starts each period with a merchandise inventory beginning balance. That is, merchandise that the firm purchased in a previous period but didn't sell during that period. So that inventory is still sitting there at the beginning of the new period waiting for customers. Of course, if the firm just started its business, it wouldn't have any inventory yet, so the value of its merchandise inventory would be 0. During the period, the firm buys more inventory. That's called purchases. Altogether, the value of the firm's beginning merchandise inventory plus the value of all of the new purchases that the firm made during the period gives us what's called the cost of goods available for sale. That is the dollar value of everything that the firm could theoretically sell to its customers during the period. We can write this formula in a more condensed way by saying that the merchandise beginning balance plus purchases equals cost of goods available for sale. That little BB stands for beginning balance. But this isn't just a formula, it's a story. And this story tells us that the dollar value of all the merchandise that the firm had from last period left over at the end of that period, plus all of the new merchandise that the firm acquired during this period, equals all of the merchandise that the firm could possibly sell in this period. So what happened to all this merchandise? Well, probably some of it got sold and some of it didn't get sold during the period. At the end of each period, the firm does a physical inventory. They add up the dollar value of all of the merchandise that didn't get sold. This is called the ending merchandise inventory. If we take the total cost of goods available for sale and we subtract out the value of the ending merchandise inventory, that will give us the value of all of the goods that did get sold. We can write this in a more condensed form as cost of goods available for sale minus the merchandise ending balance equals cost of goods sold. But again, this is not just a formula. It's a story that tells us that the dollar value of all of the goods that we could have sold during the period minus the dollar value of all of the goods that obviously didn't sell because they're still sitting on the shelves must equal the dollar value of all of the goods that did get sold. The little EB in this formula stands for the merchandise ending balance, goods that didn't sell. The story that's told on the income statement of a merchandising firm always has two parts. In the first part, we take sales revenue, subtract out the cost of goods sold, and that gives us gross profit, the difference between what it cost us to get the merchandise and what we got when we sold it. But we don't get to keep all of that gross profit. In the second part of the income statement, we start with the gross profit and we subtract out all of the firm's operating expenses. Those are its period costs, usually selling and administrative costs. And the result is the firm's operating income, how much the firm generated from doing its normal business. Let's look at an example. We're given a bunch of information for the XYZ merchandising company, and we're asked to use this information to prepare an income statement for the month of September. But before we do that, we need to understand what happened to the firm's merchandise inventory during the period. We are told that the firm had $420 worth of merchandise left over at the end of August. That means that the firm must have started September with $420 worth of inventory because nothing happened to it between the close of business on August 31st and the start of business on September 1st. During September, the firm bought more inventory. And at the end of September, the firm had $930 of inventory left on the shelves. We can use this information to figure out how much inventory the firm sold during the month of September. Let's look at this situation conceptually, and then we can look at it numerically. Remember, one of our basic rules for managerial accounting is that all costs have to go somewhere. So the firm started the period with its merchandise inventory beginning balance. And then during the month, it bought more inventory. Altogether, the old inventory plus the new inventory equals the cost of goods available for sale, everything that the firm might have sold. But what did happen to that inventory? Some of the inventory was sold to customers, and the dollar value of those goods belongs on the income statement as cost of goods sold. The rest of the inventory wasn't sold, so it should still be on the shelves, and the dollar value of that inventory belongs on the balance sheet. Altogether, the value of the goods that got sold plus the dollar value of the goods that didn't get sold has to equal the cost of goods available for sale, because all costs have to go somewhere. When solving accounting problems, it's a good idea to go from what you do know to what you don't know. So let's fill in all the information that we do know and see what we need to figure out. We already know that the firm started September with $420 of inventory because that was the ending inventory for August, so it must be the beginning inventory for September. We were also told how much inventory the firm purchased in September. If we add those two numbers together, that will equal the cost of goods available for sale, the dollar value of the old merchandise plus the dollar value of the new merchandise. We were also told that the firm had $930 of unsold merchandise at the end of September. That amount needs to go on the balance sheet. It's an asset because the firm can sell that merchandise in the next period and generate sales revenue in that period. To find the dollar value of the goods that were sold, all we have to do is take the dollar value of all of the goods that could have been sold, subtract out the dollar value of all of the goods that obviously didn't sell, because they're in the merchandise ending balance, and the answer will be the cost of goods sold. Now we're ready to prepare the income statement. Here is a basic format for an income statement. I've already put the heading on for you. Remember, the heading has to include the name of the firm, what kind of financial statement it is, in this case an income statement, and the period of time that it covers, in this case the month of September. You can see that there are two columns for numbers on the right-hand side of the income statement. That's part of the storytelling function of financial statements. The far right-hand column is for the main story. The main story of an income statement is revenues minus expenses equals income. This inner column is for subplots of that story, and I'll show you how that works as we build the income statement. We know the firm's sales revenue because that was given in the information for this problem. But we have to explain how we know the firm's cost of goods sold. So let's tell that subplot. We know that the firm ended August and began September with $420 of merchandise inventory in its beginning balance. And we know how much inventory the firm purchased during September. Altogether, that gives us the cost of goods available for sale. If we subtract out the $930 of merchandise ending balance that was given, that gives us the cost of goods sold. Now we can get back to the main plot and take sales revenue minus cost of goods sold to get the firm's gross profit for September, the difference between the sales revenue that the inventory generated and what it cost us to acquire the inventory that was sold. But we don't get to keep all of the firm's gross profit because some of it has to cover the firm's operating costs for the period. So we subtract out those operating costs, selling and administrative expenses, and the answer is the firm's operating income for the period. If this income statement was for external financial reporting purposes, we would go on and subtract out the firm's income tax expense to reach bottom line net income. But for managerial purposes, operating income is really much more useful. Here is a partial balance sheet for XYZ for the month of September. And that $930 of merchandise ending balance would show up among the current assets. Remember that an asset is something that belongs to the firm, and the firm expects to use that thing in the future to generate revenues. So ending merchandise inventory is clearly an asset because the firm expects to sell it next month. The last thing that we might want to do for XYZ for managerial purposes is to determine the cost per unit sold for September. We were told that the firm sold 1,000 units in September. So all we have to do is take the cost of goods sold, divide by the total number of units sold, and that tells us the average cost per unit. Of course, if this was a real firm, it might have very detailed information about different kinds of merchandise, and it would want to compute the cost per unit for each different category of merchandise. Now, managers have to think about whether this is good news or bad news. And the answer is, it depends. It depends on how much the firm was expecting to pay per unit. It depends on whether there have been any changes in the kinds of units sold. It depends on any innovations or changes that our competitors have made. And it depends on changes in the economy as a whole. Based on that information, managers can decide what they need to do going forward to help the firm to perform even better. This is the end of Chapter 16, Part 3. In the next section, we'll be talking about how to understand manufacturing firms.